US economy and markets seem unfazed by recent shocks. Are there any risks we should be mindful of?
Sure. I think that's interesting. And, the US economy, I think, in terms of growth, is continuing to look very, very robust. Most of the high frequency data continues to indicate a healthy trend. In fact, the jobs report that came out last week was again a surprise in terms of the strength of that, because people were worried that, given the elevated energy prices and all the other challenges, there could be some negative impact on the jobs number, but it in fact came out very strong. And in fact, the expectations of rate cuts in the US have now been pushed out further. But your question, Sonal, was about risk. So let's look at risk. One is, it's important to remember that over time, the share of GDP, which is corporate profits, actually tends to be mean reverting in nature, which means there are cycles in which profit as a GDP, as a percentage of GDP rise, and there are periods during which profits as a period of GDP fall. You can see that in that slide over here. The black line is the line which is a very, very volatile line, percentage of GDP corporate profits. And you can see from a base number somewhere in 1992, there is a gradual upward trend in this line. And in fact, it has now broken to an all time high. Corporate profits are 14% of GDP. Now, because of what I would call the political economy, economic cycles and political cycles tend to, coincide, but sometimes they also collide. And therefore, this, to my mind, is certainly a risk when you look at the US, which is that corporate profits as a percentage of GDP are just very, very high. Of course, some of this is again driven by the Max 7, but this certainly would be a risk, because what we know from history is that profits as a percentage of GDP tend to be cyclical, and certainly they have certain mean reverting characteristics built into them. High profitability causes new companies to enter and reduce the profit pool. Low profitability causes companies to exit and causes the profitability as percentage of GDP to increase. Uh, the other interesting thing to see over here is the chart on the right, which shows you the EPS growth and how far away it is from trend. Trend is nothing but this constant line which shows you the consistent increase in US profits. And what you can see is that over time, the real economy has cycles, and therefore it moves up and around the long term average. But in this last 4 year period, starting from the pandemic, there has been a significant shift. Many of us thought that there could be some setback to profits and it might show its cyclical tendency at this point of time. But courtesy the AI boom, it's actually taken off vertically, and therefore EPS growth relative to long-term historical growth trends is now significantly above trend. Now, because corporate profit margins are at a high, the PE does not look as elevated as it used to earlier, because the profitability number is so much more higher. But there is other ways to look at valuations, and I'll come to that later. But this simply is one risk. If you believe that corporate profits are mean reverting, if you believe that the political economy is always bargaining around the level of corporate profits which are fair, then you would have to worry that corporate profits are just too elevated given its typical cyclical pattern. On the next chart, if we move ahead, we have another version of this. And the reason to look at this is that, keep in mind that after the recovery, that profits that happened during the pandemic, the big jump that we are seeing in profits is actually coming from the hyperscalers. These are the AI driven companies who are significantly investing in capex. Now, their capex is a source of growth for the economy, it's a source of profits for the economy. But as companies do more and more capex, they are actually starting to dip into the cash flow that they are generating. So if you look at it in the past, these hyperscalers, which is the companies like Microsoft, Nvidia, Alphabet, Meta, all these companies put together, historically the four major US hyperscalers, capex as a percentage of their operating cash flow was significantly lower. They used to spend just about 40 to 50% of their operating cash flow on capex. That number has now climbed, and now they are spending almost 90% of their operating cash flow on capex, which means they are hardly generating free cash flow anymore. Now, therefore, this is driving profits, but Remember, even though all these companies are doing capex, on the other side, if you see how AI is being used, you can see that the AI market is still evolving. Why do we say it is evolving? If you look at the right hand side, you can see that there's been a big movement in market shares in particularly the last few months. Something like Chat GPT, which had a 77% market share going back 1 year, has seen a significant decline to 56%. And then something like Gemini has come in at 26%. And of course, Claude, much smaller because it is currently focused only on the enterprise segment of AI, but is making vast inroads. They are actually one of the fastest growing companies, and their path to profitability also looks much faster. So, why do I call this a risk? I call this a risk because now the companies no longer have free cash flow. All their operating cash flow is going into capex. Now, when you make capex, it's good for the economy, but eventually, if the capex does not generate returns, it will end up being a noose around the large amount. It will cause the return on capitals to start to fall. And when we see a situation where market shares are still evolving, it means many people are doing capex, but we do not at this point of time know who will be the winner. Is it Perplexity? Is it ChatGPT? Is it Grok? Is it Claude? Is it Gemini? These are still unknown questions. So not only are they doing heavy capex, we don't know who the winners might be. They may not be able to monetize this capex, and therefore, this to my mind is another risk that we are dealing with at this point of time. Moving on from that, we have another interesting slide. Now, I mentioned this earlier that USP multiples per se do not look very elevated, right? I mean, you can see over here, this is where the current PE multiple is. It is not very expensive. There have been many times where the PE ratio has been much, much higher. So, from that point of view, you could argue that look, the US market is not very expensive. But this chart shows you a very different behavior because what we are plotting here is the MSCI US 12-month forward PE premium. And on the x axis, we have the US 10-year bond yield. What we see is this relationship over time that initially, when bond yields go up, the PE multiple also tends to move up. But beyond a particular time, particularly once the bond yield, the 10-year bond yield breaks past 5%, then this 5% starts to act as gravity and it starts to pull down the multiple of the market. So, this to my mind is a very interesting chart. It tells you that the US market, in terms of PE, not as expensive as it could have been. It's been far more expensive in the past. But if the bond yield continues to push higher, then history suggests there is a risk of that PE multiple being pulled down. And if what I described in the previous slide were to become a actual risk, which is to say the capex does play out, the companies are not generating cash flow, but at the same time the capex does not convert into profitability and productivity for the economy in general, then you could see a scenario in which the poor return on capital, the poor investment decision, which is what it would then be treated at, along with the decline in profitability on all that capex, would cause earnings itself to slow down, and that could be accompanied by a potential risk of the valuation multiples themselves starting to come down. Current bond yields in the US are about 4.4, 4.5% for the 10-year, but with no sign of the US deficits coming down. In fact, the president has talked about spending even more on defense. This is something that we should continue to watch, the interplay between the bond yields and the PE ratio. Finally, moving on to another dimension of this. Now, it's a little premature to call this a risk, but this is just once again a reflection of US household ownership of stocks and what percentage of their total assets is sitting in stocks. Now, you can see over there that this is also typically a cyclical number. It goes up, it goes down, it goes up again, then it comes down again. Now, in the last decade after the GFC 2008-9, it has been going through a straight line in terms of the rise. Now, again, history suggests that these kind of metrics also tend to go through cycles, and therefore by being at a record high by itself does not constitute a risk. Given the cyclical tendency of this, I would submit that when you have such high ownership of stocks, this creates a cycle of reflexivity, as we call it, which is that as the market sells off, it actually impacts the behavior of households, and that in turn becomes a reinforcing feature of a recession. And we have seen this pattern play out even earlier over here, when during a positive asset cycle, household ownership of our stocks went up, and then when you saw a negative cycle, actually the ownership of stocks dropped. So this, to my mind, once again, is a risk to watch out for, because this data point by definition tends to have cycles.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.